On the sidelines of India Today Conclave Mumbai, I'm delighted to be joined by Mr. Ashish Chauhan, CEO of National Stock Exchange. Thank you so much, first of all, sir, for joining us. My first question would be around Indian markets only. I mean, we have had stellar run, but right now we are seeing volatile markets. But there's, so much happening, inclusion of India in the JP Morgan bond index, and then, Nomura upgrading India to overweight. How are you looking at these developments, and what are your thoughts?
In a way, India is, in a way, secular story for next 30, 40, 50 years. And what China did from 1979 till almost 2018-19 was also a secular story. Now people are looking at India due to variety of reasons, including geopolitical, but also economic reason on their own. And that's where you see much larger strength in Indian markets compared to the rest of the world. Rest of the world, you might have seen, has actually had negative months for literally 2, 3, 5, depending on which country you look at. India has been having a reasonably good run overall, although the markets have not gone up as much as they should. But basically, it's because the world is tightening the interest rates because of the inflation and probably other reasons. But that's where you see that India is holding up is largely because people see tremendous growth coming up in India going forward. And as soon as, like today also somebody told me who had come from abroad saying once the money starts moving back into the emerging markets, that's then naturally China is not the obvious choice. And India would actually get much larger proportion of the funds that are going to come. And naturally in India just now there is a domestic fund flow which is very nice, and that's why we are doing well.
Okay. And if you talk about F&O trading, sir, according to a report, 9 out of 10 F&O traders, they are losing their money in the stock market. But still exchanges, they want to increase the trading hours. How do you look at that?
No, those are two different issues altogether. One is exchange, the trading hours is for different reasons, that people who want to hedge get a time or get a window to hedge their risk during evening hours also. Otherwise, we basically run 6.5 hours a day, and then 6 hours 15 minutes actually, and then for almost 17 hours and more, we don't have the markets, whereas rest of the world actually runs 24 hours. Although we were the pioneers in automation, we did not go beyond that numbers because of opposition from various quarters. But in terms of the retail traders, they shouldn't even be participating in the derivatives markets. So these are, in a way, two independent issues. If somebody says that I need to be in front of my screen and I am a retail trader and I lose money, but you should not be running the longer hours. Longer hours is for basically ensuring that the assets are priced for longer duration, and the entire world does it. We are not alone. And the other side is on the retail participation in derivatives. The SEBI numbers are very clear that 1 out of 10 people only make money, 9 lose money, and that's why the retail people should be very careful. If they are not experts, they should not be participating in derivatives at all, whether for 6 hours or for 1 hour or 1 minute. Why are they participating? And they should clearly ensure that even buying in the morning, selling in the afternoon is not investments. Retail investors have to be investors, that is for long term. And there are experts, or the traders they call it, who have had huge experience, who also have a lot of net worth. They might be wanting to do derivatives or day trading, but why would a retail investor indulge in such activities?
And lastly, sir, there are various other instruments that are available apart from equity, but investors are not, really aware. So what should be done to make them more attractive to all the investors?
In a way, you can see mutual funds, which are generally very safe products. We also have ETFs, which are also operated by mutual funds, but on a very low cost. Both are gaining grounds. You can see almost 15 to 20,000 crores of fund inflow every month coming, and people who don't want that excitement but who actually want to increase their money, they go through mutual funds or ETFs, and that's how I would put it, that sometimes even we get excited by a lot of movements and a lot of things, especially in television, because it's a live medium. And the 2020 and buying just now and stop loss and all is also recommended, I see, on television channels also. And that's where basically for me, one needs to be a little more aware of instruments, but also that people are able to take advantage of any instrument that gives higher returns, like even REITs. In REITs have now become quite popular amongst people who want fixed returns or slight upside also. Bonds, again, are quite popular. Sovereign gold bond have become very, very important instruments for retail investors to invest in. And fortunately for sovereign gold bond, if you invest, you not only get the participation in gold price, but also you get some interest, which is usually not true when you invest in gold. You have to actually buy some sort of or pay bank money for the safe deposit vault. Here, the government is also giving you some sort of an interest. And so those are the kind of things people are becoming aware. They are also investing. And for me, more and more investor awareness like this. Also, exchanges conduct almost 15 to 20,000 investor awareness seminars every year with SEBI and with other government agencies, with media also. And that's how we will have to continue to do this process for probably decades, so that people become more aware of all the choices they have.
Thank you so much, sir. Thank you.
If you like the video, do like, comment, share and subscribe.